reaccumulation or run to resistance, smart money reversal, low risk sell, redistribution, distribution. Okay, so there's your market maker sell model right here. If we look at this sample set of price action, okay, you'll notice that there is other market maker sell models. Okay, we have one here, the accumulation, the run to resistance, reaccumulation, smart money reversal, low risk sell or distribution, and very quick movement in here. If we probably went down to a lower time frame, we would probably get something in here, probably close to this area, and then moves down below the original point of reaccumulation. But notice it does not clear the original consolidation. But look what it's done. It creates a buying opportunity in the model of a sell profile. Okay, see, all the context that we disclosed earlier is there, but the buy comes down at a known level of support. Let me get this line right back where it needs to be at the 91 big figure. I apologize for that, guys. So we have the buying opportunity here, and it worked within reaccumulating longs at this original consolidation. If you look at what we have done, we moved right into an ICT bearish candle, which is a bullish order block after price rallies away from it. So the down candle prior to the move, just like in the sniper series and precision trading concepts video series of mine, we discuss this is an opportunity to be a buyer. Okay, and we could use the overall context of the sell model that leads into the buying opportunity. Remember that stage, that's the second distribution, could become a reaccumulation or long opportunity. Okay, so that's the part that's going to get you mixed up if you don't have the higher time frame premise in mind, and that's why it's important that you have it, because if you don't, it'll cause you some pain and many times some frustration. Now, we had the opportunity to look at the market over here in volume 6, where we had the market maker buy model, where we had a consolidation, move down into a buying opportunity, moved up and took out the original consolidations over here. Okay, consolidation, redistribution, or run to support, smart money reversal, low risk buy, back into an area of the reversal point, and then the same thing happening that we would see here, a buy model, consolidation, breakdown to a support level, is happening here. Consolidation, breakdown to support, false attempt to go lower. This is the smart money reversal. This is your low risk buy. It comes back up, clears out the original consolidation, and then we talked about how this is the pattern here and not to be concerned about this here. The reason why I said not to be concerned about it because we're talking about it in this volume now. What is this part of the market maker buy model that we said it wasn't important in volume 6? Because at that time it wasn't important because I'd have to talk about what we're discussing in volume 7. So looking at what we have here, okay, we have a market maker sell profile here, right off of a support level, 91. We have a consolidation, okay, comes back down, retest, rallies up into an area of resistance. Well, wait a minute, what's this resistance over here? I mean, you have this big candle here, okay, but where's the resistance? It didn't come to this low, right? So where's the resistance? What was all this business? Why did it have an issue getting higher than what it did here? Let's look at that. If we have the understanding that these patterns are going to form off of support resistance levels as we deem it in the ICT camp, what caused that? What was the catalyst for this area having a struggle getting higher? That we could frame the idea that this would be an area of smart money reversal and low risk sell back down into either clearing the initial consolidation or defining it as a reaccumulation for a bullish scenario like we're going to discuss now. Well, we talked about earlier in this video series, the ICT Market Maker Collection, an idea of a breaker. Okay, if you go back over here, this candle right in here, the down candle prior to the move that's rallying up, that takes out highs. See this high here and this high here? Look what it's done. And I don't want to go over and reteach the whole concept of the breaker, but this is why it's useful to know what they are and what they're doing and how they blend with everything else in my repertoire. Okay, so we have a high here and a high here. What's resting above those? Stops. Okay, so if the market rallies up and blows them out and then comes back and ultimately comes and collapses, we go right back to the original down candle prior to the moves up. This is where they use the buy orders to run the stops. So they bought it here, rallied it, took out all the opportunities for those that were going to be short that would ride any move lower. Okay, when price comes back up to that area, they have to neutralize that. They have to take off those buy orders that necessarily weren't released here because the market moved too quick. So there's a mitigation underway, okay, or what we understand in classical terms, trader remorse. I don't believe that's the case all the time with smart money, but they use this function, okay, to take stops out. That's how it happens. This is what goes on an institutional level. So when we have price come back up into it, they only release the longs that they had to carry through all this. And when it comes back down to this area here, there is a change in gears. The market is not willing to go lower. Okay, so while there is times when certain parties of what we deem smart money is not right, they will have to work out of a position that may not be favorable for them. And because they don't trade with stops, because they have very, very deep pockets, they have to work with areas of liquidity and liquidity pools and stops and such. Prior to this move up into this area, okay, the next level of liquidity or liquidity pool was right below these lows. See these equal lows here? We talk about that as very clean levels, and that's not going to happen all the time where prices see that and it never comes back to it. Many times it'll come right down to it and clear it. So stops below this was the objective from this point here to here, and then we had a reaction away from it. Okay, and we had a sticking point right there. What was the issue there? The bullish candle or bearish order block prior to this move lower. If you go right down to the low here, you can see it goes right to it here by a pip or two more. Okay, and then comes right back down. What's it dipping into? This overall down candle here that looks like a high, very long wicked. Everybody likes to call it pin bars or a doji. Inside this candle, there's because we're looking at an hourly chart, we're going to assume for a moment that this is an opportunity that we would see a lower time frame bullish order block, and I'm quite certain it's there because if you go back and look at what we showed in volume 6, I think you'll see it. But to keep things moving along, we have these two levels in here, just as we described, would be necessary for the formation of fractals. Okay, so now let's take these off and keep this in mind. That's the premise of what leads to these patterns formation. So we have a consolidation up to a reversal point down into an area of reaccumulation. Then it rallies off. Now notice that this sell model is in the context of the overall buy model. So we have a consolidation that drops down to a reversal point, low risk buy, comes up ultimately clearing the initial consolidation with this high here, but then resumes and moves higher. Well, why was this taking place? What's the catalyst for that? Like, what's going on there? Go back to this original consolidation over here. Okay, we have a consolidation, a move lower, a redistribution or move to support, which is here. Smart money reversal, low risk buy, comes right back down and does what? It creates another opportunity to go lower, but doesn't do it. So we have a double attempt at going lower. So this becomes your false break, okay, and it doesn't go higher than the sorry, it doesn't go lower rather than the initial low here. Okay, so here's our secondary smart money reversal. Okay, and it's confirmed when you have a high here broken. So market structure resumes bullishly here, and then it really is bullish when you take out this high here, and it comes right back down and does what? It reclaims this order block. What? Yeah, it reclaims this order block to do what? To run stops again. Okay, we have stops now resting above this. Okay, there's liquidity resting above this high. Also, we have this move down over here that was rather sharp. Okay, and we want to utilize the bullish candle prior to the moves lower. Here's your bullish candle. Here's a bullish candle here. If we look at that, using either or, it gives you a nice area to anticipate. And between this level here and this level here, this high resides in the midst of them. Ultimately does blow higher, and let's note exactly what it reached into. It went above this swing high here. Even though that we have the high here, we have a swing high here. So above the swing high is where the liquidity is going to rest. And nonetheless, if it goes to this level here, just the spread alone will probably tag out then the orders that would be pending here. So we have these levels in this sample set of price action. Okay, but let's get back to the heart of the matter here in regards to the fractal patterns or sell models. We have a sell model here as well. We have a consolidation. Now I know you're probably saying, well, what about this? Why aren't you counting this? Okay, well, I'm not counting this because the price had moved away and then moved into consolidation here. What's it consolidating on? The top of this bullish candle or bearish candle, which is a bullish order block. See what I'm saying now? There has to be a model, okay, of these profiles on the context of a support or resistance or order block. Okay, so we see a very sharp move away. The candle engulfs the down candle. It breaks through it. Okay, now we're consolidating. So what's the framework or basis for support here? The top of the bearish candle, which is classically defined as an ICT bullish order block. The consolidation's here. It rallies away. Okay. Reaccumulation. Up into smart money reversal. False break. Breaks down. Low risk sell. Breaks down. Redistribution. Boom. Clears the original consolidation right in here. Let me draw that out for you just in case. I know this is probably a strange one and one you might not readily see, but I'll just give you the major parameters so you can see it conceptually. And I know some of you are rather cynical right now, saying, well, obviously this is going to look perfect because it's all in hindsight and you can't do anything with it in the past, but look pretty and smart on the video now. But I'm telling you how you should mark your charts up after the fact to learn this. Okay, by looking at fractals and the way they transition from one to another, you'll build an idea that is going to very easily digest the price action when you look at it. You'll see the patterns there. You'll know exactly what it should be looking for in terms of where the liquidity is going to pull price next. Okay, this same thing again over here in another context. It's the same way. Sell models in here. Again, I'm just going to give you the major parameters right here. Now, it's not very clear here, but again, if we go down to a lower time frame, you'll see all of the definition and details that leads to these major price points that makes up the market maker sell profile. Okay. Same thing here. Okay. Comes right back down into a reaccumulation. We have the same thing happening there. It doesn't go lower. It moves into an area of reaccumulation. consolidation, reversal. It should break below here, but doesn't. Why? Because it's coming off of a higher level time frame support level. So this is actually teaching and showing us that this market is under accumulation. Why? We have a low, it comes down, rallies again. Off of what? Using this level as an ideal area to hunt it, the 91 big figure, but the down candle, the body of the down candle, this is the order block. So it reacts, boom, okay, breaks the highs, comes back down. Does it go lower than this low here? No, it does not. Does it even get, below, well, no, I'm saying the same thing twice. It doesn't go below this low and never even comes back to try to retest this low. So we're making a higher low here. It rallies again, creates a sell model. Boom, what's happening again? We have a reaction bullishly. And then once this high here is taken out, this is teaching us that the market is what? It's under accumulation. They're buying it up. They're buying it up. They're buying it up. It's unable to make lower lows. Now, yes, it's still taking out equal lows here where the stops are, but it's not breaking down because overall the price structure is indicating that this market is under heavy, heavy accumulation. Once price rallies up here, clear out these stops, these highs and up in here, it comes all the way back down and dips into this order block right here. So again, we see an area where the down candle prior to the move up right here, the bullish order block is dipped into. But now what are we looking at in terms of market profiles as it relates to buy and sell profiles, ICT, market maker buy and sell profiles? Well, we have the initial consolidation here, the run to resistance, reaccumulation, smart money reversal, and inside all this price action here, if we go down to a smaller time frame, you'll actually see the finer points in detail what these. Well, actually, let's just do it because it really makes no sense to talk about it vaguely. Okay, here's this original consolidation. Price rallies up, reaccumulation, runs into resistance. Now, what resistance is this? Right in here. It is bottom of this candle here, the bullish candle prior to move lower, is a bearish order block, and this low of this bullish candle here is a potential bearish order block. And if you want to go back into here, this bullish candle, use the body low of the candle here as the basis at the beginning of the move lower. You see it had really nice reactions as well. And if we go to this one here, you can see it doesn't reach there, but it does get into here. So an example of institutional pricing, let's throw this in here as a means of completion. If we're looking at this whole area up in here prior to the move where it breaks out of it, if we take our level, okay, and we identify initially the first and lowest right in here. This is the lowest of the bullish candles prior to the move lower. Okay, we don't use this one because the price was starting to rally up away from that. We don't like that idea. We like the idea of the bullish candle, then the move sharply moving lower. So we have this one here is the lowest, and this one here is the highest. So this is our initial range to work within. Now we don't just say we like this zone. That's not what we're doing here. Well, what I'm suggesting to you is in terms of institutional pricing, let's change this level so we can actually discern the difference. Okay. Now we have this range, this high and this low range. What we would do is we would start dragging our level down. Okay. And what we're doing is we're looking for areas where price trades a lot to. Okay. and there's nothing really there. So like maybe 2 3 points. Right here's a good one. Okay, 92.19. Round that to the nearest round number or institutional level. It's 92.20. 92.20 is right there, and I think the actual high in this candle is the 19. Nope, it comes right at the 20. 92.20. So that's the institutional level right there. We would have as potential area to look for as price moved higher. Another area or price level would be ideal would be this one here, because we have the high of this candle's body, and we have the high of this candle and the opening of this price candle and this high of this candle here. So that's a good one. About 92.15 rounded to the nearest 5. And another level would be this one here, 92.11, and the reason why is because of the opening of this candle, the high of this candle, the opening of this candle, and the low of this candle, and the high of this candle. So there's a lot of activity around that price point. Okay, so a lot of touches to that level, and I would just round that down to 92.20. I'm sorry, 92.10 level. And it's also really, if you really look at what it is, it's half of that range right there, and it comes right at the 50 level. So that's a safe assumption to look at how institutional order, I'm not institutional order, but institutional pricing is done when you look for entry points or exit points for your particular trade. So I tossed that in there in case earlier in the video series you didn't get the concept of what institutional pricing is and how we glean it from price action. So nonetheless, I mean, that's how precise it can be. But we have price coming down into this bullish order block here, reaching up into this area of consolidation. Okay, and we just discerned how we can pull out the institutional levels inside this larger consolidation. So with that in mind, we know we have 92.10 to 92.20 as respectable levels to concern ourselves with. So let's put those in on this particular chart. Okay, so there's our two levels to look at. Smart money reversal breaks down. Doesn't really give us any opportunity to resell in here, and no, it doesn't really give you anything. The market moved way too quickly and just really ripped right back down into the original consolidation, back into an area. The body of the candle, the down candle prior to move higher, right into that order block. Boom! Look how perfect that is. I'm still amazed by it, and I've been looking at it for years. The take out this box here. So we have a consolidation, sell, right down into a reaccumulation, which could have been a distribution, but it doesn't come to fruition. We have the swing high here. This is what you would see classically at a redistribution. Okay, 62% retracement level, moving right up into the bottom or low of the bullish candle prior to the down move. Right there, perfect precision concepts underway, and it sells off. But it only gives you about 30 pips. Now 30 pips is nothing to scoff at, but nonetheless, it only comes back down into a higher time frame concept that we're moving higher ultimately, because we've been making higher lows, higher lows, higher lows, and we came down and cleared out these equal lows we talked about earlier. Runs the stops there, rallies, takes off, and now we're reaccumulating in here, where we're in an area where redistribution should take place in a market maker sell profile. This is that point at which, if you don't have the higher time frame premise in mind, it will nail you and you'll be wrong and you'll take a loss. Okay, but if you're thinking objectively with the higher time frame premise in mind and looking at the overall price structure correctly, this is what can happen. You can be looking to be a buyer down here with the sell profile, or using the buy profile right in here. We have a consolidation, price moves lower, breaks to support, smart money reversal, low risk buy, reaccumulation, clears out the initial consolidation here. I know it's hard to see, but if you think about what we've shared so far, the pattern's there. Okay, and let's see what happens. Price continues to move higher. And where's the trade up to? The institutional levels that we just noted. Look at how many times it hit it, didn't quite get there. We had some pull away from it. Trades down, runs deep into it again here. Moves right into it again. Starts to break down a little bit again. What do you see here? Do you see another market maker sell profile? Consolidation, run to resistance, reaccumulation, smart money reversal, breaks down into what? This should be redistribution. But because we're in a bullish scenario, the area that would be redistribution, we look for reaccumulation. We want to be a buyer here, not a seller for a break below this consolidation here. We don't want to see this block of orders be taken then. So using the sell profile, we can look for this area to be an area of continued support. So in other words, it should not breach this area here. Now think about what this is telling you. If we do see sell profiles, okay, that are being supported as buying opportunities, eventually when that stops happening and these areas here that would be maintained as support, if these are broken, that's our early indication that the trend is changing. How about that? That's pretty neat, isn't it? So that way you can get an x-ray view of what market structure is going to do before it even happens. That's pretty neat. Okay, so we've seen this area here as a buying opportunity. Price moves up, rallies. Okay, we have another scenario here. Consolidation, rallies up, smart money reversal, comes back down. Where there should be redistribution and selling lower to take out this area here, it doesn't. Why? Because we're in a bullish scenario. Okay, we're in a bullish scenario, so this area should be maintained or protected. You ever hear of an area where they are calling it a defended levels? This is where that idea comes into concept. This is what it looks like. This is how they defend it. Okay, so when a bank or an entity comes in the marketplace and defends a particular level, okay, it may be option expiration, it may be other factors that are fundamentally driven that it's going to be outside the scope of this teaching. This is where we see the basis of what it looks like and why they'll be defending it. Okay, they're going to defend this area here. So in other words, the profile that would be a selling scenario in a bearish market, it's going to be an area of reaccumulation. And then you'll see the classic, what everyone fell in love with when I first came on the scene in 2010, teaching concepts in Forex that's been used in a lot of my trading since the 90s, the classic ICT buy scenario. Okay, and then everyone sees a move higher in price. That's going to do it for this particular volume. I think that if you spend some time with it, again, this is only just one sample set of price action in one particular pair even. If you look at price action on all the pairs on a weekly basis, even if it's pairs you don't trade, it's good study. It'll help you discern what price action should do going forward based on what it's done in the past. And that's a good, efficient use of your time instead of just looking at the charts, not knowing what it is you're looking for, okay, and then reacting to price action once it starts moving and then chasing it. You don't want to do that. Okay, you want to have an idea of what you're anticipating and then trading in line with that anticipation. So with that, guys, I wish you good luck and good trading.